Today, we're going to be evaluating capital efficiency. We're going to look at it strictly through a financial lens. So, we're kicking off things with this critical question. How much cash does your company actually consume to create each new dollar of recurring revenue? It sounds like a simple math problem, but this single question forces us to look way past individual department metrics. We aren't just looking at marketing costs or sales expenses here. We have to step back and evaluate the business as a complete, unified financial model. And to answer that question accurately, we use a very specific measurement called the burn multiple. Now, this was popularized by investor David Sachs, and this metric evaluates the whole company by capturing every single dollar going out the door. It leaves absolutely nowhere to hide financial inefficiencies because it captures all of your operations, research, development, and administrative costs in one fell swoop. This creates an honest view between operating models. On the left, think about a highly efficient company with a 0.5x multiple. That just means $1 of burn produces $2 of new recurring revenue. On the contrary, a highly inefficient company with a 2.0x multiple is literally spending $2 just to produce a single dollar of revenue. So ultimately, a lower multiple is better. It just means you aren't buying growth at an unsustainable price that rapidly depletes your capital. So how do we find your actual number? Let's dive into the formula. It's simply your net burn divided by your net new ARR. You typically calculate and track this over a standard quarterly window, which gives you a clear period-bound look at your capital consumption. So let's look at the math in action with a straightforward example. Say a startup burns $600,000 in a quarter to add $400,000 of net new annual recurring revenue. Run that through the formula, and it results in a 1.5x multiple. So basically, they're spending $1.50 for every dollar of new recurring revenue. But to get this metric right, you have to be very precise about your inputs. The crucial point here is that the formula is only as good as its inputs. When you're calculating your net burn, you have to use pure operating cash outflows. If you start counting financing activities such as investor money coming in, bank loans, or credit lines, you're artificially lowering your burn. We also have to strictly exclude one-time expenses from that net burn calculation. We're talking about things like a massive legal settlement, a big one-off equipment purchase, or some highly unusual contractor project. If you leave those in, your multiple is going to swing wildly from one quarter to another for reasons that are entirely unrelated to your core operating model. And when it comes to the denominator, the word net truly matters. You have to subtract churned and contracted revenue from your new and expansion revenue to see what actual revenue generation occurred. So think about it. If you added $500,000 in new ARR but lost $300,000 to churn, your net is only $200,000. That's the hard number that goes into the formula. Now, what's really interesting is when we apply this metric to broader industry standards, a pattern emerges. Data drawn from real-world B2B SaaS financials shows that private startups actually convert burn into ARR slightly more efficiently than public companies at the median, posting a 0.89x multiple compared to the public median of 0.75x. But those medians actually hide two very different worlds in the data. About half of the companies are running multiples above 1.0, while a quarter are running incredibly efficiently below 0.33x. This tells us that companies are either highly efficient or highly inefficient, and they rarely migrate between the two extremes. So why is this? This is because efficiency is really an operating model. It's not just a phase you grow into over time. And on the topic of operating models, let's address a massive market myth right now. Despite popular narratives that AI companies are magically scaling with tiny teams and completely resetting the benchmarks, real data shows that AI is not inherently an efficiency strategy. There's actually only a marginal gap separating AI native startups at 0.79x from traditional SaaS companies at 0.89x. Now, seeing a higher number on your dashboard isn't always an immediate reason to panic. Elevated burn isn't automatically bad if it represents a calculated bet. So if you just entered a brand new market, launched a major product, or made a massive hiring push, that elevated multiple is really just the cost of a strategic decision. That is, as long as you have a clear line of sight to cheaper growth and a specific payback timeline. Conversely, if you're seeing a sustained multiple over 1.0 quarter after quarter and you don't have a specific strategic bet to point to, that could be indicating a deep structural flaw. And it's not just a temporary lack of spending discipline. It usually points to fundamental issues, things like weak pricing power or a product that requires way too much human effort to actually sell. And that brings us to the central idea. More capital doesn't really fix a structural problem. It just adds capital to it. It just means you're going to consume more cash to achieve the same flawed results. So to wrap up this video, I really want you to look at your own metrics and ask yourself this question. Is your burn multiple funding a deliberate strategic bet, or is it quietly funding a structural flaw? And as you probably guessed, your answer to that question will determine if you have a sustainable, efficient path forward.